My name is Robin Vallely. I work for the McCombs Alumni Relations Office. I want to welcome all of you here tonight. I'm going to introduce one of our former board members of our BBA Advisory Board. Her name is Elizabeth Horn. She has been one of our rock stars. Elizabeth has played a major part in our annual...
Thank you, Robin. I will choose not to do that. Thank you. Welcome to Dr. Spellman's postgraduate class this evening called Talking About Exuberant Financial Pricing Despite the Slow-Growing Economy. Ouch. Many of you all know Lou Spellman. Many of you all subscribe to his blog called the Spellman Report. If you don't, you need to. On the Spellman Report, Lou is famous for analyzing the intersection where the economy, economic policy, and financial markets meet. He's an expert on this because his views were shaped by his years as assistant to the chairman of the President's Council of Economic Advisors. He also worked many years at the Federal Reserve Board. Lou's been a finance professor here at the McCombs School of Business, and he has also taught many classes at the LBJ School of Public Affairs. I'm impressed. I did not know that. Lou got his MBA at the University of Michigan, his PhD at Stanford University, and we are all so blessed to have him teach us tonight. Please welcome my dear friend Lou Spellman.
Thank you so much. Elizabeth, I think, we figured out 73? I think she sat like back there in 1973.
This is our third grade class.
Well, some you don't forget. I still actually in Colorado listening is the fellow sat in the middle of the first row of the first class I taught. So, in fact, the early ones you remember better. But thank you so much. Glad to see your students grow up. Okay, tonight's agenda is a follow-up from the last time. This is version 2. Oh, let me do an advertisement first. The Spellman Report. I hope you all subscribe to it. It's a freebie. It comes in about once every 6 weeks or whenever I can get it around to it, which is about 8 or 9 a year, something like that. It's not going to jam up your inbox. And basically, the issues, from my perspective in writing it, the issues get bigger and bigger and more meaningful, actually, as we go through time. I hope you also push it off on your friends as well. Thank you, and I'd appreciate that. This is the second evening, September 19th, What's Behind Financial Market Exuberance? What caused me to do this, basically, in essence, I had put this aside about 5 years ago. I used to do it more frequently then. But the environment had become so out of sorts in terms of our understanding of economic growth. We were just faltering. At the same time, the financial markets were exuberantly priced. And of course, every day you pick up the Wall Street, there's doom and gloom, and it's all going to come apart tomorrow. I've read it so many times, I'm beginning to think about it myself. This was the basic argument why it might not, or why it won't. We'll find it, we'll evaluate it, let's put it this way. The odds are against it, let's put it that way. So, given the inconsistency relative to all our prior understanding, not only as an academic going through maybe learning this as Liz did sitting in my class years ago, but basically after 10, 20, 30 years of reading the Wall Street Journal from writers who went through that class or that kind of class. So basically we've learned it by living through it. And but things were totally awry. The economy could not retain its old growth rate. It was not clear why. That's what the the source of the last lecture was on the 12th. But at the same time, the financial markets were exuberantly priced, certainly not for the lower growth rates we had and presumably the greater risk. So there's this great inconsistency. So I thought it would be well worth getting you all together, put the word out, and try this again. In a way of advertising, September 26th, a week from tonight, same time, same place. Although we might do it earlier at 6 because of some people have indicated that going home and coming back is difficult, so perhaps we might experiment with a 6 o'clock start, but I'll put out an email to determine exactly the time. But in any event, next week is really, I think, the more important one from your perspective. It's the baby boomer dilemma, investing in these unusual circumstances. Prices are stretched, the economy is slow, and by the way, as of today, the Fed really rolled up its sleeves and no longer is equivocating on the issue of, quote, normalization, which is basically everything that I'm presenting today. What they're saying is we're going to start reversing it. So then what I'll be doing next time is really changing the script to see how far they can reverse things and what will happen as they try to sell off the assets they purchased and whether or not they'll be able to do it. I'm very skeptical. They can get very far myself. But we'll evaluate it next time. And it makes it as doubly difficult as a baby boomer in retirement, I'm one of you, trying to figure out exactly how do you position yourself in this environment. Stretched prices, and the Fed is now working against you instead of for you. So that's next week. I would think that's the most important part of it from your perspective. Okay, background for tonight. The whole last Tuesday evening was the slow GDP growth and why. In a nutshell, there were two major reasons, just to get you up to where we got to last time. I actually wish I brought the graphs in. But we've had slow economic growth or GDP growth because we have extreme debt service. And it's the debt service as it's the consumer plus the corporate sector plus the state and local, but moreover, most importantly, the U.S. government. We went into the 2008 recession. We had $10 trillion of debt. 10 years later, when Obama leaves office and Trump is sworn in, we had 20 trillion of debt. So basically, the level of government debt doubled. The first 10 trillion took 228 years to accumulate. The second 10 trillion took 8 years to accumulate. So it vastly changed the ratio of debt to income, and it vastly increased the ratio. It's not just absolute growth in debt, but it's relative to your income base to debt to service the debt. So then it becomes now a strain, and what we looked at were the implied interest expense or interest carry for the federal government of their debt. And basically, when you double down on debt, you double down on interest service. And it's a strain. It matters. It might be at this point 3 or 4 or 5% of GDP. It's more like 3 or 4 now. But very shortly, it's going to get 5, and that's under the assumption that the Fed kept the rates where they are. Now the Fed is trying to raise rates so that interest carry cost rises in proportion to the interest rates. And they're so low, you can go from 2 to 4 very quickly. That's if they can. I basically wonder if they can. But the point is, we are debt constrained. And being debt constrained, it means a larger proportion of your future income has to be devoted to paying debt off. Now, conceptually, what all this means is the Keynesian solution to economic distress is for the government to borrow and spend. It's called fiscal policy, but he never addressed the debt accumulation. And the other part of the Keynesian beat the recession formula is have expansionary monetary policy, which is to lower interest rates and encourage us all to go to the bank or the financial system, borrow money, again with debt, and buy something. So it's both either. And by the way, this past go round, the consumer actually contracted debt because going into the 2008 period, they had so expanded their debt for the housing expansion. But the corporate sector really bit hard, and they're very debt extended, and the U.S. government is very debt extended. So what has occurred is we've had an increase of the debt to income ratio, and it means your debt carry takes a bigger proportion of future income, which could not be spent, and hence the income generation in the country is a reflection of spending, because everything spent at a corporation gets distributed. It gets distributed to workers, it gets distributed to rent, to interest, etc. Every dollar gets distributed, some of it to retained earnings, but every dollar spent gets distributed. So the spending creates the next round of income. And so basically what we're doing is now committing a bigger proportion, and I say bigger proportion, it's not numbers like 50 or 60%. All you have to do is lose 3% of the income flow a year. That means your growth rate, we're talking about when you're growing well, the income flow rate is growing 3 or 4% a year. If you're in a recession, it's only typically -1. So the whole range is 4 or 5%. Maybe now the Great Recession went way down, -7. Our typical recessions in the post-war period were 1. But usually we're talking about to get to +3, and then you take 3 away from that for debt service, then you're growing at 1 or 2%. And then on top of that, what we also covered last time was another, quote, leakage. It's a leakage. Economists call these leakages. How much of the income gets leaked out where it doesn't come back, where it doesn't get spent and come back as income the next round. The other one that we discussed was globalism and the effect of globalism on the income generation in the U.S. Basically, since the 1980s, since I think about 1983, I think is when it began. Prior to that, we were typically running small surpluses of 1 or 2%, more like 1. So as a contribution to our income stream of +1 most every year. It was in narrow range, around 1. Then after about 1983, it went to -3. It ranged to, we had 1 year of -6, but basically in the last 83 to where we are today, that's 34 years, and basically we've been, with the exception of 1 year, we've been leaking abroad, and the average rate is about 3%. So if you're going to lose 3% of your income stream to pay off debt, and you're going to lose 3% of your income stream running a trade deficit, that means 6% have to be made up just to stay even. So actually, by running a +2 growth rate, that's phenomenal given the leakages we've had. So basically, what we've just gone through is a very unusual period. Certainly, we didn't have those trade deficits. All this is a result of legislation and inter-country agreements regarding tariffs and trade. So globalism was phased in, and actually got phased in starting at 83. The NAFTA that we were more familiar with was under Bill Clinton in the 90s, and that was a little bit broader. It was the US, Canada, and Mexico. But all along, we were going through different trade agreement reconciliations with other countries, and basically at this point, there's very, very little. The only thing that we have in the way of trade blockage are things like you try to single out a country because they're not behaving some way. But basically, we have an open global economy. Now, for those of you who went through this course, and if you hadn't gone through this course or one like it, you've been living in this world and where you daily see the reactions in the market. And basically, globalism has changed everything. It really has changed everything, and I'm going to get into it tonight. It not only caused a change in our ability to grow, but interestingly enough, what we're going to present tonight is the other side of globalism. We lost in trade, but we won in finance. And that I'll be discussing. So it's changed the environment very, very dramatically. Okay, so we have a slow growth environment, generally compromises corporate cash flows and market prices. This is what we're all accustomed to. Booms eventually run their course, the stock market eventually runs its course, the prices get elevated relative to earnings, relative to the growth rate we see coming in the future. And the growth rate is very, very important. There's a exercise that we do typically in Finance 101. I don't teach Finance 101, but every once in a while I have to remind my students of it. Basically, if you take $1 of earnings today and you do the mathematical exercise of have it growing at an exponential rate of G, the growth rate. Okay, and that's a positive G, and it goes forever. And in finance, they teach you if you have a dollar coming in of earnings coming back to you at a future time, you got to discount it to today's value. So basically, the whole model of Finance 101, I could put it in a sentence. You take today's earnings, you try to make an estimate of what you think the growth rate of that earnings will grow forever. I guess you want to cap it at some point, you might, but basically, at some point, you buy a stock. There's no duration. There's no end of, it doesn't terminate. Conceptually, it's forever. And then you have to discount it back to the present. So it turns out that the price you'll pay today really is a function of those two variables. The growth rate, obviously the higher the growth rate, the more earnings in the future, so the more you'll pay for it. But then the discount rate discounts it back. So basically, it turns out that the PE ratios really mathematically boil down to the difference between the growth rate and the discount rate of that growth. So basically, that's why we're flustered about today's environment. You see a lower G and you expect lower PEs, price earnings ratios. But instead, we're getting high PEs. And everyone thinks the market is out of sorts. Well, maybe after tonight we'll have a different idea of it. Okay, so basically that has been a question. I could have brought in 20 descriptions in the newspapers in the last week of the overpricing. That's a general concept out there. All right, the second point. Not only with equities seemingly overpriced given our experience, but also bonds, risky bonds, bonds like corporate bonds or state and local bonds that are getting risky now. Basically, they tend to sell at a lower price, and the explanation is the lower price means a higher yield to the buyer, and the higher yield is for the risk of a default. And the risk of a default obviously grows in slower growth because the revenues coming in to pay the bond off will be diminished. So basically, what we have are exuberant private bond pricing. We have, the prices are high, the yields are low. Extreme, in an extreme. Also, how about rents? Real estate and rents. The capitalization of $1 of net real estate income is capitalized at a very high price relative to experience. I know this town is full of real estate developers, and one after another in the last 2 or 3 years have said, I've sold everything because it's beyond anything that I would ever buy. And maybe they're sitting back there right now because they have nothing to manage. Honestly, I keep hearing that frequently. I'm sure you do too. And then also, there's something else that's mispriced. The government debt itself. With the debt ratios to income being as high as it is, it should set off sovereign risk pricing. We did have some in Italy. We have some among the European countries. You know, Greece, typically the question is how big is it over Greece? But the United States basically gets a buy by the market. And that's really assumed away, and it shouldn't be assumed away given the debt numbers we went through last time. All right, so basically we have a mispricing in the financial markets relative to the cash flows that the economy is generating to service these financial claims. Okay, so the question is, what could be supporting these asset prices? Well, there are three main lines of discussion on this. The first one is going to be central banks, the grand scale of central bank purchases. Just to tell you where we're going with it, the second major category is the financial support we are receiving in our financial markets from the winners of the trade wars. They take their earnings and reinvest it back in the States. The third one is just simply the finance of the availability and the low cost of borrowing, which leads to more leverage in several different areas that I'll discuss that are taking place, and every day we see some kind of article in the newspaper about it. So those are the three main areas. The central bank purchasing, just to give you an idea how large it is and how extreme it is. Furthermore, there's a new dynamic underway that we never had before, and it's a result of globalism. It started with the Bank of Japan. They got in trouble first. It started in the 1990s. Basically, China started coming on. They lost a lot of their exports. They went into deep recessions. They had been winning the trade wars in the 70s and especially the 1980s. And then China comes along, and the emerging markets of Asia took away a lot of their market share. And basically, they went into a deep, deep, deep recession in the 90s. And then it became the 2000s. Here we are 27 years later, and they're still pretty much in the hole. Then their demographic problems kicked up, just like ours are as well. They're ahead of us in the demographics. So basically, Japan can't get its economy going still to this day. So they did some extreme things. They, I guess, learned the Keynesian formula as well, which was extreme easy money and expansionary fiscal policy applied to the extreme. I remember in the 1990s, they were looking for projects for the government to finance, just to spend money. And if you remember the expression, roads to nowhere or bridges to nowhere, that came out of Japan. They were literally cutting roads that went nowhere. They just had to have a reason to spend and borrow the money and keep on spending, and kept contractors working while the money was flowing. It didn't get anywhere. It didn't get anywhere. They ended up running into a debt service problem, the other side of Keynesianism. The first part is it generates income when the spending is taking place, hopefully with a multiplier, which we talked a bit about last time. The GDP multiplier is way down from what it used to be. So we're not getting that follow-on other spending as a result of $1 of government spending. So basically, then you start to have to deal with the debt side. When Japan started this in 1990, they had a clean balance sheet as a government, relatively clean balance sheet, far less debt than the United States, proportional to their income. But boy, did they pile it on in the 1990s, and fiscal policy and monetary policy. It was gone, they used it to the extreme. A recession-fighting fiscal and monetary policy creates debt. It stays in place after the income stimulus is over, particularly if you do not have a GDP multiplier on the spending. And that's not taking place the way it used to, mainly because of the debt service that follows on. As I discussed last time, and it's worth mentioning because some of you hadn't been here last time, when Keynes set this out, that you borrow and spend, the assumption was that $1 of government spending generated $4 more of private spending. Well, that number is more like 25 cents or 50 cents now. So you're not getting the added spending. So basically your debt is accumulating, and what I showed last time is in the last 10 years, the debt is accumulating faster at the margin than income is growing. Every year we add more debt than income. And so we're going further and further out on the ratio of debt accumulated relative to income. So this problem's not going away. And then we talked about the future indebtedness of the U.S. having to do with the demographics. And the numbers are extreme, and they're just really kicking in. The Keynesian formula got used to an extreme. You were fighting ostensibly in their discussion of it, in their planning, and everything that comes out of a central bank's or government's mind is we're fighting the recession. The unspoken issue, and they will not say it, they got to be thinking of it. Are they running easy monetary policy to get interest rates down because of the accumulated debt, to get the debt service down? Or are they doing it to bring unemployment down? Well, all the language is in unemployment because a central banker cannot say, I'm worried about the debt service, the ability of the government to cover its debt service. Because guess what would happen? It would be a run on their bonds, the bond prices will fall, and then the secondary market on the bonds would go up astronomically. So you can't say it, whether it's Japan or Janet Yellen, you just can't say it. And by the way, there's no guidance. When Elizabeth introduced me, my first job was at the Fed. Can you imagine that coming out of school? Being an economist with the Fed, but it was great. It was, one day you're learning out of in a classroom, the next day you're seeing it in operation, and at that time the Fed was a good bit smaller, and I actually had the ability to sit in on some open market committee briefings. So you see it, and you see the discussion, and you see what they say in public, and we had another episode, just to reflect on this for a second. When the government debt builds up and you're worried as a central banker about it, you can't say, I'm worried about the debt, because the interest rate for the government will double. I mean, if you're a corporate treasurer, you can't say, I wonder if we can, if we could debt service this debt. You don't say it. Everything you say is the exact opposite. All the confidence you can possibly exude, you do. So they can't say it, and it's nothing in law that says they're supposed to do it. So basically, this is all out of the inner circle in a very private conference. Now, I got to the Fed in the 60s, and still they were reliving an episode like this, and it was in World War II. I could still chat with the people who were advisors to the board at that time. They were still there, they hadn't retired yet. And I went out of my way to do it because I knew something about this. Basically, World War II starts. And of course, we were concerned about the size of the deficit, the debt sales, the percentage of taxable income that would be devoted to servicing interest as opposed to having the income to purchase war materials. So interest became a competition for war materials. And the Fed on its own, this is an amazing story. I used to do this in class. I don't know if you remember, Elizabeth. The interest rate on the Treasury debt for the first about 80 days after Pearl Harbor, first 80 days or so, it didn't rise. And then suddenly something happened on the 88th, by the 89th day, within 1 day short of a quarter, suddenly the interest leaped on the U.S. Treasury rate. The Fed went to the reason being, people started saying, what's ahead? In a debt-strapped economy, they're going through a war, they got to do a lot of financing. And furthermore, if you don't win the war, the other side doesn't pay the debt off. If you ever give that a minute of thought. So there's a lot of risk there, and a lot of strain to pay it. So the market started to react, and the Fed, who is every day buying and selling bonds even then, believe it or not, the Treasury didn't go to the Fed and ask them to support the price. The Fed went to the Treasury, if you can believe it, and said, look, you got a debt problem. You got a debt service problem. We propose to you that we will step in the market and we will support today's prices, quote, for the duration of the war. And that phrase ended up being almost a legal battle when the war was over. Was the war over? Legally, it didn't end until 1950, I think it was. They had a fight thereafter. But basically, the Fed told Treasury, you got a problem. And they didn't even realize it quite yet. And they said, we volunteer. They had, by the way, had no legal authority, none whatsoever. Nothing in the Federal Reserve Act neither commands them to do it or says they should do it or consider it. They just went ahead and flung and did it. It's like government today. If you make it up as you go, and who's going to take you to court? And would the Supreme Court take a case like that? Well, they don't have the authority to do this. Who's going to stop you? So basically, there was a letter agreement between the Fed and Treasury, and the Treasury, believe it or not, at first reluctantly accepted the bond support by the Fed. And then when the war was over, given the accumulation of debt, by the way, at the end of World War II, we got to the same debt-to-income ratio we have today. So we were in a similar position. And then we had, in 1946, the soldiers came back, the war was over. During World War II, there was huge savings. We would say almost 15-20% of income. We had rationing. You couldn't buy things. There were no cars. You couldn't, literally, we had huge buildup of consumer wealth, liquid wealth in commercial banks, and they started spending like crazy. They hadn't, after all, they had not bought durables for the Depression years. They did not buy durables during the war years because there was rationing, and you couldn't, those new automobiles were not available. They couldn't be produced. And gasoline was rationed. Everything was rationing. The savings rate, I think, was close to 20%. So when the war was over, they celebrated and went out and had a big go to the shopping mall, whatever the shopping malls were at that time. Inflation rate got somewhere between 15 and 20%, just on extreme demand. So then the Fed, in its inflation fighting role, puts on their inflation fighting hat and goes over to Treasury and said, the war's over, we now have to tighten money because we got too much inflation. And the Treasury says, nothing doing. We like these low interest rates. They continued with those incredible low interest rates at the same level that we are today, maybe 2%, 10 years, less than, half of 1% for things, in under 5 years, something like that. So basically, the Treasury said nothing doing. Well, they couldn't command the Fed. So basically, they had an intergovernmental agency jockeying for 5 years before it was finally settled. This is an interesting story. I didn't intend to do it, so I'll have to do the rest of the lecture more quickly, but I got you to this point, I got to finish it. So they go through 1946, 7, 8, 9. There was a little recession in there. They get to June 1950, and the Fed is still putting a peg, it was called the peg, holding up the price of the government bonds. They wouldn't let it fall. If they let it fall, the interest rate would rise. So they were holding the price above market. And something happened in June 1950, which now I see replaying on TV these days. The Korean War began. And the Korean War begins in, I think, June 21st, 1950, I think it was. And basically within no time, because we had so much consumer rationing during World War II, the consumers headed for the grocery store and emptied it out. They bought everything canned and put it in their basement because they didn't think they'd be able to buy food. Created it about instantaneously, like a 9 or 10% inflation rate instantaneously. So the Fed goes to the Treasury and said, look, we got to control the inflation rate. We got to be out of this agreement with you. And Treasury says, nothing doing. So this fight continues. They do it in front of Harry Truman. And basically Harry Truman, his attitude was, I'll tell you what he said. I just read it last summer, actually. He said, during World War I, I was in the Army. And part of my salary went to buy government bonds. And when the war was over and I get out and I had the savings for the war coming to its fruition, and I go out to sell that, whatever it was, $1,000 bond, and when the war was over, it turns out in the market, that bond price fell, the interest rates rose. There was a big inflation in the early 20s. He said, did I feel cheated? I not only fought the war, but I financed it. And then they stiffed me on getting my money back for financing the government. And he said, I don't want that to happen. That was the global mindset of Harry Truman. This is amazing how some these decisions are made, really. The context. I could just imagine being in the White House today, what the context would be. I'm sure it'd be some kind of real estate deal in Boston or something. But that was the context. But it finally got solved, and the Fed got free of the agreement to keep the bond prices up because we had so much debt. And the way it happened was a few months later, and shortly thereafter, actually, the Secretary of the Treasury, who was saying nothing to the Fed, you can't get out of the peg. It's in our national interest. Now, especially, we're in a Korean War. Well, that same Secretary of the Treasury had a cataract operation. And in those days, they put you go for surgery and they put you out totally. So he goes on, he's anesthetized, he's out totally, and in the government, before you're incapacitated, you sign your authority to your next in line. You might do it for corporations too, I don't know, probably so. And it got, of all people, some of you might remember the name, the Undersecretary of the Treasury was William McChesney Martin. He was second in line. So basically, when he goes under the knife and his underling becomes the acting Secretary of the Treasury, he calls up the Fed and said, let's do a deal. Well, I'm still Secretary of the Treasury. We got it this afternoon. I promise you, this is how it happened. So his deal was, as Secretary of the Treasury, I'll let you out of this letter agreement that we signed in 1942, in March of 1942, on the condition that I become chairman of the Fed. so that so I'm there to monitor how far you let the interest rates rise. Now, think of what this required. It required the existing chairman of the Fed to resign. It required Harry Truman to be sold on this idea and appoint the Undersecretary of Treasury, acting Treasury Secretary for the day, to be chairman of the Fed, to be confirmed later by the Senate. And basically that was kind of set up in advance because the Senate had been having hearings on that for some time, and they knew where they would go with that issue. They had already discussed it and come to their own conclusion. So basically, that was the condition under which William McChesney Martin became chairman of the Fed, who I worked for 3 years and occasionally got to speak to. He didn't retire until 1970. But basically, he was there from 1950 to 1970. Then he had to fight LBJ with similar kind of things during Vietnam. But nonetheless, interesting. So the point is, there was absolutely nothing in law that either instructed the Fed to or caused them not to be able to support the Treasury bond market. And they did it without law, just on a policy. And it was an intergovernmental jockeying of the outcome. And so basically, we've been in it before. At the end of World War II, we had similar debt-to-income ratios that we had today. And basically, during that period of time, the Fed, during the wartime period, supported the price above market. And how do you do that? As we talked, I think, somewhat last time. If not, we'll go through it today. You print money and you buy bonds. And you get the bond price above market high enough, and the interest rate is converse to the price of the bonds. So basically, that's where we are. And the unspoken issue, the last point, that tipped the scales became the interest carrying cost. That's why they did it then and now. And they can't say that they're doing it, just like then. They never said it. None of that stuff became public. If you're interested, the reference was in the memoirs of one of the members of the board who was the former chairman, and it was in his collection at the University of Utah Library. And I actually was able to download it last summer, where he wrote memorandums of recollection on the episode. But in any event, so here we are with an unspoken issue. Whoops, okay. Now, when you take it to an extreme where the central bank prints money and buys and buys, prints money and buys and buys, what it means is the bond price rises and the interest, now remember, and let me just bridge this gap, it's a small gap, and I presume most of you understand it. A bond is a fixed income instrument. Basically, they're typically denominated in $1,000, and the face of the bond tells you the coupon, how much you will pay every year, and to whom and where, etc. So what is the coupon? And that's printed on it, and it doesn't change. That's why they call it fixed income. But what can change is the price in the market. So if the original issuance of the bond says we will give you $5 a year for every $1,000 of face value, what it means is the yield to the buyer totally depends on the secondary market price until maturity. So if the bond is issued at $1,000 and the Fed next day goes in, prints money and buys it and drives the price up to $1,010, the price rises, so the yield to the buyer has been reduced because he paid $1,010 for a $1,000 bond, which would, at $1,000, it would have yield 5%. But buying it at $1,010, the yield to him is less than 5%. So basically, interest rates move opposite in the fixed income market than to the price. And it's just all mechanical. And so basically, buying raises prices, lowers interest rates. So now the Bank of Japan, seeing the extreme level of indebtedness, and unfortunately, I wish I now brought that in. They're way beyond us. They're at a debt-to-income ratio, all sectors of 6 to 1. A consumer, Liz, what would it be if you go to buy a house? Your income had to be about 3 times your mortgage payment. That'd be the max, something like that. So basically, they're 6 to 1, and you as a consumer, the banks won't let you go past 3 to 1. So give you, and you struggle with 3 to 1. So, so basically 6-1. They were way up there, and so this is the 1990s, the 2000 period, up till relatively recently. They pushed the price so high that which means the rate comes down, the interest rate comes down, and then one day we pick up the Wall Street and it says the rates have been pushed into negative territory. Now, how do you possibly get the rate to the owner of the bond negative when you're receiving the coupon payment? Well, the way the rate gets negative is you push the price not only above the ultimate principal you'll be paid back, but you push the price above the sum of all the interest payments you will receive, so that you pay more for all the benefits than you receive. That's a negative rate. And they can do it just by pushing the price above into that territory. And they've done it. And by the way, a lot of Europe's doing it. I'm not sure what the current recent number is, but we're still there with negative rates, not quite as extreme as it was about a year and a half ago. Now, what does it mean? If your central bank is pushing rates to the point where it's negative, what it means is it's a tax imposed on the lender for the benefit of the borrower. Because basically you might have paid, let's say for a 2-year bond with a 10%, with $1,000 principal, and let's say 2 years of $10 interest, and you push the price beyond $1,020, you'll get less back than what you paid for. So it's a negative return. So basically it's a tax on yourself. Let's say you push it up to $1,100. You pay $1,100 for a bond, and you only get back $1,020. So basically it's a subsidy to the borrower. So who in the world is going to subsidize borrowers, particularly the government borrower? Well, it's going to be someone who has a gun to their head. What was the, we'll give you a price you can't refuse. I think that's what it's called. Who would do that? Well, very few people would knowingly get into a deal where they're going to lose money. And with certainty. The uncertainty is you lose even more. So basically, who would do it? Well, the central bank would do it. So basically, the central bank is giving a part of its net worth in the subsidy to a government. And by the way, that's become an issue with our central bank because we don't have any more net worth to give away. We're way down there, about 1% net worth of the balance sheet, very, very low. So basically, there's a limit on how much you can do it before the central bank itself goes upside down. Not that we have a process to liquidate the central bank, but the point is, if you find out that the numbers show a central bank that is insolvent with a negative net worth, you're going to have a run on the currency just because the headline would crash, cause people to run and scramble out of the currency. So basically, what you're doing by putting prices that high and yields that low, you are subsidizing the government to be a borrower. So it's a tax. It's a tax. Now, if you as a consumer somehow get forced to buy that debt at a negative rate, basically it's a tax on your wealth. It's a tax. Okay? You're giving them a contribution. You're not getting back what you paid for it. What a deal. Anyway, we're real close to that. So basically, it's a tax. So the question is, who's going to do it? Well, obviously, the central bank, if they have net worth to dissolve, and our central bank doesn't, and I'm not sure the Bank of Japan has it anymore. But basically, how about a commercial bank? Well, can you get a commercial bank to basically impose a tax on itself in the support of the government? Well, you can. It's called regulation. You shall have X amount percentage of your portfolio in government bonds and short-term government bonds where the yield is essentially zero. I haven't pushed it negative yet, but the point is you can, by regulation, impose it on probably pension funds, insurance companies, commercial banks, financial institutions in general. So basically it becomes a wealth tax transferred to the government when you get into such a bad debt situation. So that's basically what it is. Without that headline on it. They're trying to figure out ways to get this to go down where it sounds more judicious than that. We're taking your money to support the government. Okay, so basically, that's where they pushed it. Once ultra-low interest rates are set in motion by a single large central bank, now here's the next episode of how the world has changed. It spreads to all central banks. There is a mechanism. When Liz sat in my class, we probably talked about the money supply multiplier, which was a multiplier of the central bank printing $1 and buying $1's worth of bonds, and that from an investor who then deposits it in his bank, from which the multiplier was the commercial bank's lending would grow. The old-time multiplier was 8 times every dollar that the Fed would print. So the multiplier at that time, that we taught for years, had to do with a commercial bank multiplier. Well, the multiplier today of the Fed to the commercial banks is closer to 2, not 8, that it used to be. For reasons, regulatory reasons, is all part of the downdraft of the Great Recession, for which we ran out of capital. They're still trying to rebuild their capital to be able to expand that much. But we have a different multiplier. If a large central bank starts supporting its own government and drives the interest rates down to de minimis levels or even negative, think about what takes place. There's a chain reaction that I got to walk you through, because we have a new dynamic in the world, and you got to really be with us and understand it. If rates in Japan become very low, domestic private capital will seek a higher return in another foreign economy. I.e., we have investment managers who are trying to get high rates of return. And the flip side of globalism, it's not just open trade, it's open finance as well. Prior to this, in the old world, we had capital outflow restrictions. The U.S. never had one, but virtually every other government had it. Maybe in the 60s, 70s, and 80s of the old days, the only countries that allowed capital to freely leave would be the UK, the US, Germany, Switzerland, and there may be 1 or 2 others. It might be South Africa. So basically, we had very few open capital countries. But the flip side of globalism, it's not only open trade, but it was also open finance, which very few people realize happened in the background. But think about what it means. So if you have the central bank of Japan pushing the government bond price up, the yield down, you as an investor in Japan, particularly with the demographics of the population, you're not earning much on your savings, so you start looking around the world, or your investment manager starts looking around the world for a higher return. Well, if U.S. is still in normality and our rates are 6, 7, or 8, and there it's 0, 1, or 2, there's a huge spread of how much more could be made in the United States. So think of the second link in this chain, and there are about 3 links in the chain, I think it is. First, the central bank prints, buys, pushes price up, rates go down. Second link, the investment manager says, the hell with Japanese government bonds at 1%. I can go to the U.S. and buy treasuries and not have, quote, risk, and they're paying 5, and they're paying 1 in Japan, or 0. So basically, that sets in a process where you now liquidate your Japanese holdings. You then have to go from the yen to the dollar market, so you got to go through the foreign exchange market. So you convert to dollars, and in dollars you buy treasuries. So now you're sitting in another currency in a treasury with a spread of 500 or 600 basis points. Now, true, there's going to be usually, depending on your time horizon, if it's long, it's probably not worth taking the insurance. If it's short, you could get foreign exchange insurance. Basically, you can buy back the ability to reverse the transaction in the future. Probably about 0.5% a year would be the cost of that. If you're a long-term investor, you wouldn't bother. You're just really looking at the prospects of the U.S. economically. I don't think, but basically what happens is, if the Bank of Japan enters the market, raises prices, lowers the yield, the investment managers say, let's look across the world, not only on debt elsewhere, that's the first thing you look at, but how about what is the return on preferred stock in the United States? What is the return on equities? So basically now you have a mechanism by which the Japanese debt problem becomes financial buying across the world of all kinds of assets by the investment manager out of Japan. So it doesn't matter which central bank it does it. Now, in the process, here's another dynamic that happens. It drives as the capital flees Japan, the currency gets cheaper because of selling. The dollar gets more expensive. Well, most countries don't care for when a foreign monetary policy starts to make their currency expensive, and now we can't sell our exports. And you call up the guy in Japan and say, what are you doing? We can't, I just got called by Apple. They can't sell their iPhones. You can't do this. So basically, the country receiving the capital ends up getting cut off from foreign trade. Now, the U.S. is least dependent on foreign trade. We still are, actually, and we're losing that game. But most of the emerging markets of the world, and even the large countries, can't afford, in globalism, once you open up trade, basically, if their currency gets expensive because the capital is fleeing Japan, and basically then you have your income starts to diminish because you can't trade. And then suddenly all the export industries start knocking on the door of the central bank or the president or the prime minister. And basically you got to somehow insulate ourselves from the monetary expansion of Japan. So this is a new problem in today's world. If some country does a monetary expansion, it ends up buying in your market, but it goes through the foreign exchange market first, and they got to buy your currency, which elevates its price, and then the next thing you hear from all the exporters. So basically, the countries start buying immunization or protection from that kind of development. So the question is, if you're sitting, let's do it in particular for another Asian country that's an exporter. Suddenly their currency appreciates, and for the emerging market countries, exports is the biggest part of their economic thrust, much bigger part of their economy, and they win in it. And suddenly you start losing. Now you got to insulate yourself from that monetary move in some major country. So what do? I guess you got three options. So you're sitting in that country, capital's coming in, and basically it's causing now the bond prices are rising, the yields are falling, but the currency price has affected your ability to export and hence income, which is the bigger issue for most countries. So basically, and by the way, also the central bank of the country receiving the capital said, what are you doing? You're doing monetary policy in my backyard. You lower the rates in Japan, so they want to invest somewhere where the higher yield is, so the capital flows to another economy, and the price rises and the interest rate goes down. So basically, what the expansionary monetary policy in Japan ends up floating over to every other country and basically having domestic economic implications because they're messing around with the interest rate in another country. Now, a few years later in this whole dynamic, the U.S. got into it and got big with the QEs. When we went to QE in 2007, after Japan did it, we did it starting in the last 10 years. And basically the central bank chairman of Mexico, the central bank chairman of India, they were all up in arms that what are you doing creating monetary policy in my backyard? That's my job. So basically, they were really looking at a couple things you can do. You can say no foreign capital coming in, but that starts reneging on your ability to trade. So basically, that's one thing you can do. They haven't gone that way. Brazil had an interesting offset to this. They created a capital inflow tax of 5%. To me, that's the most intelligent way to do it. You start running a government subsidy, a government surplus. They had a capital one-time upfront capital inflow tax of 5%. That sure slowed it down and sure fed their treasury. So that would be an intelligent way to do it. The other way to do it is if the central bank, let's say in Brazil, had similar low interest rates to eliminate the incentive for capital to flow from Japan to Brazil. So that forces you to have a easy monetary policy. The decision was made in Japan, but Brazil has to follow through with the same rate. So you lost control of your monetary policy. The biggest guy on the block ends up creating the interest rates across the world. The third possibility is to intervene in the foreign exchange market to offset the appreciation of your currency so you don't lose in exports. And that could be done directly by printing money and selling your currency against the other currency, so it depreciates your currency. So or the fourth way to do it, which is what was happening anyway is if Japan's rate was lower and you're up here and the capital is flowing where the rate is higher, obviously, the other way to do it is you just have a monetary expansion to get the rate so that the differential is eliminated. So what that ended up doing, which in fact has been the adjustment mechanism, is basically if a major country expands with very easy money and the interest rates get low, it forces all the other central banks to turn on the printing press, buy assets, and get the rates at the same level. So basically it's spread out to all central banks. So this is what it looks like as a result. You can imagine, this is what I just walked you through, the problem for the receiving country. This process has created a new money supply multiplier. The multiplier is a big central bank buys a lot, lowers the interest rate, and it forces all the other central banks to buy a lot and lower the interest rate. So you end up with a money supply multiplier. Let me give you an idea how big it is. This is the total assets of the major central banks. That would be, I guess, four. It would be probably the UK, the ECB, the Bank of Japan, and the US. That's who it would be. And it would be, this is during the Great Recession when the great expansions were taking place. We expanded, we called it QE, quantitative ease. Give you an idea how big it was, I'll get to that in a second. But you can see that we started at 6, looks like 6.3 or 4, and we ended up last March at about 18. So a triple, 300%. We did a triple on monetary expansion. That's all these central banks. Huge numbers. To give you an idea of relativity of where it used to be in the days when we didn't have to respond, when central banks didn't have to respond to the low interest rates elsewhere. The Fed, when I was there, actually I was engaged in a study of at that time we were into business cycle timing and how to get rid of business cycles. And I did analog computer simulations of monetary policy. And basically, so I'm pretty aware of the numbers, an average buy per year by the Fed was a 4% increase in the money base. And they went up 300%. Now, granted, that's over 10 years. But the average buy was about a 4% per year. So if you do 4% a year for 10 years, it's 40. There's some compounding in there, so let's make it 50. So over that period of time, if we hadn't had this globalism and trying to, defend yourself against foreign capital coming in and defend yourself against losing exports, really, that's the defense. Basically, it forced a 300% increase in the monetary base in 10 years. And that's the major ones. Now, here's the numbers on the right-hand side. The major central banks were plus 300% asset buys over the 9 years. All central banks, and Rudy, thank you for supplying me those numbers. You add in the emerging markets, it ended up being 383% increase. And those are the ones most effective. They're smaller, but they're more effective because they were losing exports. So we had this humongous, by certainly historical standards, increase in the monetary base and money across the world. And low interest rates, and you gotta match the low guy, whoever it is. And if you don't do it, you lose exports. So that's the new dynamic that rules the world and accounts for these things that are so, beyond our recognition, really. So basically, the whole dynamic is these 4 points. Over-indebtedness causes you to go to Keynesian expansion, which creates over-indebted fiscal policy, over-indebted monetary policy, and then it creates the need for ultra-low interest rates, and then it spreads to all central banks of the world. And that's what's happened. We're still there. Now, I should have brought it in today's Wall Street front page. They're now getting determined to have, quote, normalization, which says unwind all this. Well, I'll leave that one to next Tuesday because it very much affects, are they going to be able to normalize? And it very much affects you and your portfolio. Tremendously important event. Can they do it? It looks like they're finally getting the will to do it. But the question is, can they do it? There'll be forces fighting back, let me put it that way. You raise interest rates, and then you're back in a Keynesian world of you're having less, borrowing, Or think of the corporate sector in America. In these low interest rates of the QE years, they went into huge financing way down the scale of the junk debt. Huge quantities of corporate debt outstanding at very low, extremely low interest rates. Now, if you start raising rates and you start to slow the economy, they'll not only, and by the way, when junk bonds get refinanced, the maturity on junk bonds are typically short, 3, 4, 5 years. So we're getting to the point where they got to get refinanced. So if they got to get refinanced in a higher yield environment and with a slower economy, they're going to pay more default points. So basically, you're just suddenly going to have a default issue with our junk issuers in the U.S. And I'd be very surprised if that doesn't happen. But basically, that's what we're looking at going forward. It creates, so if the Fed at this point starts to normalize, we got a whole new dynamic on our hands, which I'll go through next Tuesday. I hadn't expected to, but I will, because it's probably more important than the things I was going to talk about. Okay, so central banks purchase a purchase of government bonds creates prices of all financial assets. Elevates prices of all financial assets. That's the takeaway. They buy bonds in the first instance, but then it spreads by the portfolio managers who now have the liquidity to every asset. So basically it spreads out to stocks, it spreads out to preferred stock, it spreads out to real estate, etc. So all prices everywhere get elevated because they're substitutes for that very low yielding government paper. So this is the process. It affects all assets. Now, a quick note. Basically, what we have here is a formula for asset inflation. Now, when you all took this course, and when I taught it, when I took the course myself, and years of teaching it, you associated this kind of increase in money with inflation. And indeed, Milton Friedman ran the regressions of how more money generated was associated with. He implied generated, but it was associated with more inflation. And basically, that can happen. But in this instance, there is an important issue you got to understand. When the central bank buys, they're buying on the secondary market from portfolio managers. So basically, they're bidding up the price of existing debt. So basically, they're spending the new money in the financial markets, and it spreads to all other substitutes. So basically, you have financial market inflation as opposed to goods inflation that we all were taught 30 years ago. And it can go into goods inflation if the interest rate gets low enough and creates enough borrowing and spending, but it hasn't done that. And could get into goods inflation if we all look at our net worth when we get our statement from Merrill Lynch and we say we're rich, let's go out and buy a car and a boat and a bunch of things. So it can bleed over into the goods markets, but so far it hasn't. So the way more money does directly bleed into inflation in goods markets is if the government buys, or if the government buys goods. Or in other words, if you finance the government at the time they're issuing the money and then they turn around and pay you for Medicare expenses, then the new money directly goes into goods. So far we haven't gotten to that. The central bank is buying existing debt at higher prices from private owners who then have a capital gain and they spread it out to all alternatives. We can get that way, but it's not been that way. All the buying is for financial assets, and we have generalized financial asset inflation, but not generalized goods inflation. In fact, the inflation rate looks like it's getting closer not only to zero, but possibly negative, which is another interesting discussion of next week. I think we're there. If you really get rid of the biases in the CPI, I think we're actually there. You don't feel it when you buy food at a restaurant in Austin, but otherwise we're there. Okay, so we have asset inflation, but not goods inflation. It could turn to goods inflation if the central bank financed the government In other words, if they bought the debt from the government, who then goes out and spends it in the goods markets, as opposed to buying the debt on the secondary market that already exists. So that's an inflation of the existing asset base. Okay, now, here's another thing that'll blow your mind. And it wasn't until my TA sent me this last night that my mind was blown. Not only are the central banks, in this case of Japan, buying government bonds, but in the below yellow or orange, I guess it's orange, the central bank is buying equity ETFs of Japanese equities. And look at that. And basically, this graph is not the central bank asset purchases. It's the Bank of Japan, the ETF whale. It's the percentage of ETFs in the Japanese market that are held by the central bank. So it's not quite the same terms of what we looked at before. But basically, not only, we're asking why, when central banks are trying to support the government, does it elevate the price of everything, including stocks? Well, you can see they're directly buying equity via ETFs. And that bleeds over to us, because as soon as their prices get so high and the yields so low and the prospects get so low, the PEs get too high, their portfolio managers sell to the Treasury or to the government and basically come over here. So basically, we are also getting supported by the Bank of Japan, although none of us realize it or feel it or see it. Who else is doing this? The ECB, the European Central Bank, is buying private debt. So they're supporting private corporate debt. I don't think anything to this extreme. So far, the Fed has not, as far as I know, stepped over the line. But basically, now you see where the support also for the equities are coming from. That's quite amazing. Certainly not the old model. As a matter of fact, the Federal Reserve Act specifies what the Fed can buy with printed money, and certainly stock prices, equities is not part of it. There are only 5 things the Fed can buy by law, although I can't imagine them paying attention to the law any longer. Government bonds, gold, bank loans from commercial banks that are members of the Fed. Let me see, what else can they buy? They make a deposit at the IMF, which basically is an asset. And there's a 5th one, and I can't remember what it is. But it's basically a monetary type, government type asset. So basically, now they have come out beyond bonds to equities. So that's where the support is coming from. Okay, now that's the end of the first mega line of thought of why prices are so high. It has to do with the central banks intervening to make life easier for the governments, and then it overflows to prices in general. And we're all looking at high prices and unbelievable PEs. All right, second issue. Kind of reset your mind. Basically, we got to get to a whole nother issue: the effect of globalism on asset prices. I've kind of made mention to it, but let's go through it very specifically. Global trade has been adverse for the U.S. Last Tuesday evening, I showed you our current account deficit by the year, and as I told you, it's been running on average like 3% negative, as bad as 6% in some years, and few years only -1. But we're right in there. I think that's about where we are now, about -3% negative. So basically, what happens to that 3% negative of our trade? Well, it ends up being accounts receivable for a foreign exporter. And it turns out the accounts receivable for the foreign exporters are huge, and basically it's a surplus on top, a savings surplus on top of their domestic savings surplus. Basically, they sell stuff to the U.S., get paid in dollars. Probably the money still sits in a U.S. bank. They own it. And basically, it's running at a very, very high rate. Let me show you how much. Basically, our loss in goods and services turn out to be earned claims by foreign exporters, and they're in U.S. dollars already. So they're already in dollars. So they have savings, and it's already in dollars. It's sitting in U.S. banks. They run large current account surpluses that provide the savings for investment abroad. And I'm going to give you some idea how far this has gone since we've gone to globalism. It's really far. First of all, this is the size of the problem. Combining, and where's it coming from? The combination of East Asian and some European savings economies, and that would be mainly Germany and maybe the Netherlands. There are a few trade surplus economies in Europe, mainly Germany, the biggest one, but Asia in particular. Basically, Asia, they're running, you add together, and this is by year, and this large peak over here from Asia of Asian surplus dollars financed the housing boom. And it was in 07. Basically, that's what kept the buying going and the rates low, and we overbuilt housing, and we ended up having a housing recession. So basically, foreign savings is intervening in our economy dramatically. Now, it turns out that they're back at it again. Now we're back to where we were again. So the East Asian economies are doing this. The red line is the surplus from the European surplus economies, which are a handful of them. Probably Germany, probably Netherlands, I'm not sure who else, but there are a few of them. Now, it turns out that their savings glut, Asia, is about $700 billion a year, just reading it off the graph, and it's denominated in US dollars. So their savings, $700 billion a year. European are saving $525 billion a year. It ends up being $1.25 trillion a year. As compared to that, the US savings of our consumer is $700 billion. So basically, the foreign savers are beating us out almost 2 to 1. So their gains end up actually being our gains in the financial markets. We lose it in the economy, but we gain it in the financial markets. So are we going to tell them to stop doing it? Well, I guess that's what Trump is trying to say, I guess. But the point is, the flip side of the trade deficits is a surplus accumulated there, which largely gets invested here. It could get invested in any economy, but these are worldwide asset prices, and it does get spread worldwide. But in the first instance, it's basically earned in dollars and sits at U.S. banks. So basically now, their savers are what's determining how much savings we have out there and the rates as compared to the U.S. savers. They're de minimis by comparison. And here's the discussion of it. Tell you where it's coming from. The combined savings of China, Japan, Korea, Taiwan, and the 2 city-states of Hong Kong and Singapore is about 40% of their collective GDPs. So not only are they winning by trade, but they're saving 40%. You know what the savings rate in the U.S. is? It's 3.5%. That's why our contribution is so small. 3.5 and they're doing 40. And they're winning the trade game. So basically, they're accumulating U.S. assets at a very fast rate, and I will show you how much that has happened. So basically, we got to win the trade war to stop this. But meanwhile, on one hand, we're losing the trade war. On the other hand, we're winning in finance, so to speak. And I guess you have to say, if we do suddenly throw the book at them and cut off all foreign trade, we would also cut off that inflow. So you'd have a financial impact as well. All right, perspective on annual purchases of U.S. assets. Clearly, the winners of the foreign trade are contributing more into the pool of asset purchases than U.S. savers, and it shows in the U.S. net asset holding position. Okay, the next one is they're winning a trade, they have dollars, they're buying U.S. assets. We earn some foreign assets and buy some foreign assets as well, so taking a look at the net. The net is something called the U.S. net interest in foreign assets, and basically the U.S. liabilities are their assets. So basically, they've accumulated this amount. This is since 00, so in the last 17 years. So the foreigners are accumulating U.S. assets, which are liabilities to us. So it tracks the growth of the foreign ownership of U.S. assets and then compares it to the U.S. ownership of foreign assets. So we've gone upside down. We used to have a net positive. We own more of the foreign countries than they own of us. Well, since '00, you can see the net going from break even down to the number is minus 10 trillion. Our GDP per annum is 20 trillion. So basically, they've net accumulated an amount equal to 50% of our annual GDP, which is a big number. Now, the implication of this is not only are they getting rich relative to us, they're where the U.S. used to be. They're exactly where the U.S. used to be. We own foreign assets, and we were receiving the interest and dividends from foreign producers that generated more income and more spending here. Now it's the exact opposite. We're working hard to pay the Chinese and the Koreans off. So basically, they're draining part of our income. And so, and it's a very big amount. It's a very big amount. See, I was telling you that there's more to the story of the size of the U.S. Government debt interest service, the service on the foreign debt. The issue is who owns it. If an American owns it, well, it's income. We tax Americans for the government to be able to pay Americans, so it doesn't leave here and doesn't leave our income stream. But we tax Americans to pay foreigners, like China owns a couple trillion of U.S. treasuries. Basically, we're paying a higher interest rate so they can have a lower tax rate. That's where it is. So, total emphasis has to be, to be honest, I don't think Trump has the intellectual understanding of what the importance of competitiveness, but the whole issue is competitiveness. And everything about regulation and allow firms to compete and get capital and train people. Competitiveness is the entire story. It's no longer Keynesian manipulation of currencies and borrowing. We've lost in that game. And basically, 100% emphasis has to go to supply side ability to be run a trade surplus instead of a deficit, so we can start accumulating foreign assets again and work that back down. So he's right on. You got to question whether he understands it. I think intuitively he understands it. But nonetheless, that's what we have to do because we're that far underwater. We're getting taxed at a higher rate in order to pay China and support them so they can have lower tax rates there. They're living off of us, both in trade as well as government finance, both. So, okay. Okay, so that's the second major leg of why prices are so high. The first one was the expansion of the central banks. The second one was, and the buying by central banks of assets. The second is the buying of U.S. assets by foreign trade winners. Now we're going into a whole third area. And this one is going to, unfortunately, get you to feel like you're back in a finance class. So I'll make it very short and as painless as I possibly can. Basically, we have a low interest rate environment with a lot of easy credit. That sets off, I think I've detailed 5 different market responses. When money is cheap, interest rate is cheap and highly available, there are a whole variety of reasons to borrow and use the money. And all of them add to the purchasing power of other assets. So it also supports assets. The first one is just the basic finance, which which is low interest rates. I did mention what we do in Finance 101, which is basically you present value the stream of future earnings, where it's growing at a rate G and discounted at a rate R. And it turns out that the value of the asset depends on the difference between the growth rate and the discount rate. Heuristically, you can understand it without me doing the math. The math would just confuse you. Just heuristically, you can understand it. So basically, when interest rates are low, there are an awful lot of portfolio managers out there who are not just betting on the next 6 months or what the Fed will do and have a 2-day window in their mind. Some of them are long-term investors like an insurance company. because you know what your long-term liabilities are, and you know, so it gives you an idea what you got to earn on your assets. So basically, they do discount and calculate the value of an asset based on the interest rate. And when interest rates are low, there's less discounting of future income, so they pay a higher price. So just that alone causes higher prices of institutions. Certainly, number one would be pension funds, who really do understand the schedule of their liabilities into the future. So basically, there's an awful lot of buyers that just simply do the hard math, and to them it's simple because I've been doing it so long. Basically, the level of the interest rate determines the present value of future cash flows. So if the rate is lower, and indeed in this hyper expansion of monetary policy of buying bonds and getting interest rates low, basically they're now valuing assets at a higher price because the interest rate is low. What it means is that there's less discounted value of future income. It's less discounted, so it's worth more in the future. So that happens automatically. That's Finance 101, and we still have enough people that do it in an analytical, knee-jerk way. No, excuse me, in the analytical way as opposed to the knee-jerk way. So basically, low rates by itself will lower the discount rate that they discount future earnings. So basically, it makes, in their mind, we can bid a higher price for an asset when it comes up on the market. Okay, number two, low interest rates promote more leverage. That's, I'm sure it's axiomatic, almost axiomatic. You get more leverage, and what kind of leverage takes place? What it means is you borrow, and with the proceeds, you buy some other asset. So, and you and I do it with houses. We go to the bank when the interest rates are low, and we buy a house, and basically it finances us, and our interest carry is less. So we can afford to pay a higher price for the house than we would otherwise do. So basically, you and I do it. Anyone who's ever had a mortgage, you do it. Anyone who's had a car that was financed, you do it. So basically, low interest rates promote more borrowing and purchasing assets. So it drives up the price of houses, drives up the price of automobiles, etc. And it also drives up the price of other assets because people do borrow in the financial market to buy other assets. So what kind of borrowing takes place to buy other assets? Well, for one, it induces more mergers and acquisition activity financed with cheaper debt. So when you hear about an M&A happening, some company borrows a heck of a lot of money and buys a competitor, for example. You merge it or you acquire it. So basically that has an uplift on prices in general. It also has a secondary impact, which I'll get to in a minute. Well, here it is. In turn, there are fewer publicly traded stocks which serve to make them scarce and more highly priced. We've had a huge rash of M&A, mergers and acquisitions, where a company in an industry knows it borrows money at a low rate and buys a competitor, either buys it or merges with them. And they buy out the stock of the competitor, and where they get the money is from the borrowing. So we have M&A that's taking place, and it's all financed because of low interest rates. It has not only the effect of raising the price, but it also has the secondary impact of having unbelievably fewer public companies that are traded in our financial markets. The numbers are surprising. Here they are. The number of U.S. public companies has fallen by almost half over the past 2 decades, even though the U.S. economy and population grew. So the number of names on the market, I think the Wilshire 5000 is now 3,400. So I guess they got to revise their literature. But you have fewer choices out there. It means, and you're a manager of your own account or you're managing someone else's fund, you have fewer choices. So basically, scarcity is number one in economics, microeconomics. Scarcity creates higher prices. And that's a big, big fall off. That is really a big fall off. Then the other thing we were hearing about, and which I think is finally tailing off, another way to make money with the cheap money as a company is to borrow more money on the balance sheet of the company and use the proceeds, instead of buying your competitor, buying your own equity back. Now, what does that do? Well, number one, it levers the company more, so that the returns to equity ought to rise if everything else stays the same. You're more leveraged and also more risky. But then you take it to another extreme, not just borrow more, but buy the shares outstanding, so there are fewer shares outstanding. So then the higher earnings attributable to equity, to the equity to the owners, now is cut up by fewer owners. So the earnings per share rise. And hence, we're getting earnings per share increases, which people are interpreting as growth. That's not really growth, that's redistribution. So basically, we have this false sense of earnings growth, where a lot of it is simply redistribution as a result of the cheap sources of capital, of debt capital. And here's the buybacks. The buybacks were rampant, but they now seem to be waning. This is a very busy graph, but basically what we see, and there are two ways I guess they measure it. One is by buybacks to net income, the S&P 500 buybacks, the left scale. But basically that's in the light blue. The light blue are the number of buybacks that are taking place. And you can see we really reached a maximum. It looks like we reached a maximum in early 16. And here we are late 17. So I think it's tailing off at this point. So basically, but what it has done, part that has me most concerned about where the economy is going or where the financial markets are going, look how much debt it added, and that's mainly junk debt. And when you get to an interest rate increase, and the Fed's was very earnest today in saying we are going to normalize, and they're going to try to reverse this whole thing that's been going on for a decade and start selling and selling, which means the prices go down, the rates go up, and the firms with junk ratings or relatively low ratings means, and virtually all those maturities are relatively short on junk debt, like 2, 3, 4, 5 years max, and a lot of them took place earlier. They're going to start having to refinance, and if indeed the Fed gets its wish with higher rates, that rate will rise so that the market value of the equity will be less, so they're going to have a reverse leveraging effect. Basically, they're going to be paying a higher base rate, and on top of that, they'll probably be paying a bigger default premium because the market sees that their interest carry has risen, so they're more likely to go under. So you not only will your base rate go up, but your default premium will go up to where it's really significant. You might go from 5% interest on junk debt to 7 or 8, and that makes a material effect on what's left for equity and whether the company will survive. Actually, one of the things I'm looking at is looking at really focusing on shorting those kind of companies. Companies that are having to refinance who are in the junk debt category. It's a total change in my outlook. I'm mainly a growth-oriented person. Now I got to learn how to short these kind of situations. As a matter of fact, one of the fellows in our office has been doing it even now, and he's an analyst looking for growth, and on the side he's shorting, and he's making 10 times as much on the shorting than he is on the growth positions. So we're really at that point, and I think it's going to set in. All right, so basically, buybacks, just borrowing and adding to debt increases the return on equity as long as the debt is cheaper than the cash flows on the assets. And basically, you magnify the returns to equity. But on top of that, if you remove the equity shares, it further adds to the impact on the earnings and hence the stock prices. I think we're about to unwind that whole thing. It looks like it's going to happen. All right, now here's another way cheap interest rate and debt availability affects prices. I don't really like this graph. I couldn't find one better, but basically there's another way it would work. With you and I, we have an account at Fidelity, and you think the markets are headed up, you can go in and have a margin in your account. Basically, you can borrow up to 50% on your existing assets at a very cheap rate. So you can increase your asset holdings by 50%. and it's happening in a big way. The red, obviously, is going to be the margin debt. By the way, it's measured as growth as opposed to level. So I'd much rather see a chart with the level of prices and the level of debt as opposed to the growth rate. But nonetheless, obviously, margin. I have a margin account, not with other stocks, but using it for something else. Actually, another investment. Actually, there you go. I'm using it for another investment. It just doesn't happen to be a market traded investment. So basically, every form of debt. Oh, how about another one? There's another one that's contributing to this. Austin's own Michael Dell went and borrowed a heck of a lot of money and bought the stockholders out and went private. So basically, and I think yesterday I saw Nordstrom is about to do it. Company after company are basically borrowing money and buying their shareholders and going off the market. So basically, we end up with fewer stocks to buy, and basically, and on top of that, we have another current regulatory issue, which is a problem, which is the difficulty or the regulatory cost of getting public as a startup company. So basically, we have fewer companies, and hence the same spending power, in fact, enhanced spending power, gets spread across them at a higher price. So we're sitting in this state of certainly the inconceivable thought 10 years ago that you got a lousy economy and a great financial market. So basically, they're levering off finance to try to support the economy, which overflows to financial markets in a dramatic way. The only question is, now that the Fed has said they're going to normalize, and it was all over the Wall Street today, and you're going to hear an awful lot about it, and I guess I'm going to discuss it next Tuesday because it becomes an issue, because next Tuesday is going to be an issue of, I call it the baby boomer, but it's not just the baby boomer dilemma, it's everyone's dilemma, trying to figure out how to invest from this point, from such a high level, and such support that we've had, incredible support of the financial assets, and then you start going into another environment where the Fed is trying to turn the whole thing around. I'll save my thoughts till next time. I hope I see you. So that's all for tonight. If anyone has a question, please come up and use the mic if you would, so we can get it on the tape. So we're open to questions. I've taken as far as I can. I'm going to. You mean I've blown you all the way that no one has a question, except where's my passport? And actually, you know, one other issue is wealth protection in general. Sir.
I'm thinking back at when the oil crisis hit Texas back in the 80s, and you know, the problem.
Tom, why don't you face the camera?
Yeah. Oh, I'm sorry. And the problem that the people that were producing at the margin had, the supply ships, the tubular products manufacturers, when the line went from, you know, here's the production and here's the demand, and all of a sudden that line crossed, it went not, you know, a 10% reduction in the demand for tubular products, for example.
Yeah.
It went to a zero demand for tubular products, and just because that line crossed.
Right.
And so,
right. Yeah.
I'm using that as an analogy.
When the music stops.
Yeah. In other words, if in
Yeah.
fact the Fed not only, you know, maybe stops supporting asset prices, or central banks begin to stop supporting asset prices, but actually begin to unwind the balance sheet. Even if they didn't unwind the balance sheet, even if all they did was stop supporting asset prices, what areas of the financial markets in particular do you think might suffer the same consequences that maybe those tubular products manufacturers did, to where there's, you know, the price swing and the impact of that sort of realization in the market could have on prices? And
Well,
where do you think the most
I think the amplification would occur, as I said, with the junk bond people, because basically they now get into a default problem. on top of the higher interest rate, but their default prospects rise, and then that gets priced as well. So I think it would be the lower, you start with the lower end, and then you work, the most solid is the last thing to be affected. Similar question I had, I was in California this summer, and I went to school at Stanford, I think, as Liz said in the announcement. Basically, I've been watching the California real estate market for a couple decades, and it was kind of the thing that never stopped going up. Guess what? It also, well, basically, and it's going to continue. I love to short the California housing market. It's happening. So what first got my attention was a piece in one of the newspapers, maybe Time magazine, of a person who had bought a house in Monterey, which is a fine place. When I was in graduate school, I used to run down there every weekend that I could, go play golf, and think clearly, be able to think clearly. But basically, she had this person had bought a house in '08, the beginning of the housing bust, at the height actually of the housing bust boom. I think she paid $800 in Monterey. 10 years later, the best she could get for it was $400. So basically, I was, and then since then we were having. California is in net migration. I'm not sure it's net. I think it's net. External migration out of California. Well, all you have to do is ride out Highway 71. You can see a city of Californians being built there. So I warned a friend. I was in San Francisco a few weeks ago, and I warned some friends that. Maybe it's about time to get out of this. It's not the manifest destiny of how California housing prices ever rising. And of course they blew it off because they lived there their whole life and basically can't imagine anything else. But it's true. The question is, which ones go first? And basically this duplex in Monterey went before something in Atherton, say. So basically you start unwinding with a lower quality, lower support. California is a unbelievable mess. They have a statewide pension fund that is not making their required earnings per year to fulfill their obligations. They have to earn on their portfolio 7.5, and at the same time they have to invest conservatively, so they're not making it. Which, by the way, might be part of the Fed's motivation because they don't want to be responsible for those defaults in pension obligations that are going to happen, and they are going to happen. So basically, what's going on in California, they passed a law saying whatever the shortfall of the investment management of the fund, the state legislature would make up the differential. Well, it turns out the state didn't have enough room in its budget to do it. So they started borrowing, and then after they got their credit rating stretched, then they raised taxes. And I think last time around, they raised taxes. They went from 11 to 13% on their income tax, the top bracket. And then this year around, I think they're going to a higher sales tax. So what happens every time the shortfall of earnings occurs, the legislature has to come up with more money. They got to raise a tax. And guess what? It creates more Californian Texans. Or in Nevada. I went to Nevada on the other side of, by Lake Tahoe. They were also fleeing there. Basically, they're fleeing to Nevada and they're fleeing to Texas and maybe one or two other places. So basically, they're having net migration. So what's going to happen to the housing prices? Well, at first, the marginal houses really get hit hard, and then later, maybe the mansions. As a matter of fact, a good friend of mine who taught here at UT told me about a wonderful deal he found in San Diego overlooking the ocean at unheard of prices. And I told him, I said, yeah, in 5 years, it'll really be unheard of because you ain't going to get half of that. So the marginal stuff goes first. All right, any other questions? Did I just totally blow you away or just worry you to death to the point where you don't even want to think about it? No, it's a big issue. I'm going to discuss it next time. When the Fed starts ramping up with its normalization, it's basically trying to put into reverse the whole thing. They can't put the globalization into reverse. If anything, if the Fed somehow does get the rates up and doesn't bust a lot of companies and put the economy upside down, basically it's going to bring more foreign capital in, because the rate differential will increase. So you might lose on central bank buying but gain on foreign buying. And then the question is that good or bad? Yes?
Cheap question. What are you buying on margin that's not market?
I'll tell you next time. Yeah, actually, there are things out there that are worth doing. Yeah. Okay, any other questions? All right, well, thank you. I'll see you next Tuesday.